We've taken our recent webinar on stock compensation planning and divided it into 5 topical segments. The following segment discusses how to measure and monitor risk in company stocks. I hope you'll enjoy it.
So the way that we typically look at risk is utilizing something called a risk number. It is a fairly simple concept, scoring investments on a scale from 1 to 99, 1 being the most conservative investment, think of cash, and 99 being the most aggressive investment, think of Elon Musk putting all his eggs in one basket. One thing to understand with risk is, from an investment perspective, it is not to be confused with loss. Risk is defined as if the market is up X, you are up X times 2 or X minus 2. The major thing I think for this audience is to think about how your stock comp impacts the risk of your other investments and vice versa. So most executives we work with will have a 401k, will have maybe some other outside investments, and then stock compensation may or may not, may be a large part of their overall portfolio, and it can have a large impact on the volatility and the upside downside of the overall investments. I do want to get into some specific examples of how this would work. Something to keep in mind as we move into that, a few common benchmarks for risk. As I mentioned, one would be cash, things like money market and treasuries. The aggregate bond market, Barclays US Aggregate Bond Index, is a 24 on this scale. And the S&P 500 is a 75 on this scale. So when we think about stocks aren't a 99. The broad measure of the US stock market, the S&P 500, is a 75. So that's something important to keep in mind. So generally speaking, while the risk number is a fairly simple concept, most investors are oversimplifying how to target risk. So the one thing I hear a lot is some sort of variation of, I'm retiring, so I need less in stocks, right? This could be, very similar for, I'm young, I can take a lot of risk, or I can be 100% in stocks. So the conventional wisdom is, how much do you have in stocks? How much do you have in bonds? But what I would like to look at is the risk spread in different types of stock. So if you look on the right-hand side of this slide, you'll see a few different listings here with different risk numbers. First one you can see says risk 97, so we're close to the top end of the risk scale. This is XBI, which is the biotech sector ETF, taking the top 10 holdings in that ETF. So risk 97. And at the very bottom of the list, you see something that says conservative dividend payers. So this is 15 dividend paying stocks. And you can see the risk number there is a 59, with the S&P coming somewhere in the middle at a 75. The point is that both are 100% in stocks, but there's a vast difference, 40 points on the risk scale, in overall risk. What this really means is that XBI, its 6-month volatility, is anywhere between down 39% and up 48%. The 59, the conservative dividend payers, on a 6-month volatility, are anywhere between down 12% and up 19%. So that's a huge discrepancy, and obviously taking less risk means less reward. You can see the less upside. But the point is it's all stocks no matter how you look at it. The S&P 500, for reference, on a normal 6-month volatility is anywhere between down 17% and up 23%. This is going to be due to multiple factors, for all of these different examples. Could be based on market capitalization. Biotech companies tend to be smaller. S&P 500 obviously is the 500 largest at the market cap weighted index. Proportion of growth as a dividend, typically the larger amount of growth coming from dividend, the more conservative the stock is considered to be. Price sensitivity is another major risk factor, as well as both the industry and the sector. You can see, between pharma and biotech, there's a difference in risk number. So these are most of the factors that are going to impact risk in a portfolio. So when we're thinking about adjusting risk, there's a few things to look at. So we've heard of diversification. I'm sure this can mean a lot of different things, but just as it pertains to stocks, for the most part, what we are looking at are those factors that I just described. So the dividend stock, so you can see a 24-point reduction in risk, meaning these stocks individually are an 83 on the risk scale, and based on the different correlations between these stocks have reduced overall risk by 24 points. For pharmaceutical stocks, you can see based on the ETF that we utilized, the example, individual holdings are around a 97, and the correlations create a 7-point risk reduction. It's going to be a lot more difficult to reduce risk when you have concentration in a single sector, which Jay is going to explain here in a minute. What I would like to talk a little bit about is a specific example of how stock comp creates greater risk in a given position than the underlying position would imply. So what I mean by that is, if I take Johnson & Johnson as an example, you can see on the right-hand side of the screen, Johnson & Johnson is a large company, healthy dividend. The risk number is a 68 on that scale. So if you just own Johnson & Johnson stock, your risk level from a volatility perspective is actually less than the S&P 500. Now, you can see on the screen worst case, best case. So anywhere between down 14%, up 24%. The thing to realize is that when this is held in an option plan, think a non-qualified option plan where there's a strike price, maybe an ISO, you can see at the bottom, there's a negative cash position. So we're using that to reflect a strike price. What it does is it pushes up the risk of the stock. So it goes from a 68 to an 89, and your upside downside goes to down 24%, up 40%. And the reason is because the strike price acts as leverage. And that leverage will magnify your upside and downside and create a greater risk than what the underlying position would imply. So at this point, I'd like to pass it to Jay to talk a little bit more about how concentration in a given position can create more risk.
Thank you, Dan. Just building a little bit on what Dan just explained, we put together this chart, and what we basically did is we created a baseline, which is located at the left side of the chart, and this consists of 70% stocks and 30% bonds. And we can see that the 6-month volatility can be anywhere up above 17% in gains or down to 10%, a little more than 10% in losses. Then what we've done is we've taken this baseline that has no individual company stock exposure, and we've built in here a 20% position in a large pharma stock. And then the third set of bubbles is a 40% position in a large pharma. And on the right-hand side of the screen, we've then done the exact same thing with a biotech firm. The point of this chart is basically that concentration in company stock can significantly increase the potential for gains and losses. And in this example, we can see that ranges on the downside anywhere from a 10% range on the baseline all the way up to 42%. So the theme here kind of is that every stock is not the same, and we cannot view stock exposure as stock exposure. It's very individualized and needs to be looked at company by company. And that's very important for executives who have exposure to individual company stock.